Welcome to 5 Minutes for Finance, where we give you important money management strategies for small business owners. Here's your host, David Worrell.
Do you make a habit of reading your financial statements? Maybe you print them out from QuickBooks or your bookkeeper hands them to you at the end of the month. You look at them, get kind of a blank stare on your face, set them aside, maybe you never get back to them. Hey, today we're going to take care of that. I'm David Worrell. This is 5 Minutes for Finance. We're going to teach you how to read your 3 key financial statements in this series. Today we're talking about the income statement. Check out my other videos for the balance sheet and the statement of cash flows. Ready to get into it? Here's how to read your financial statement. First of all, let's understand why we have a financial statement. Financial statement reveals the hard truths about your business. Did you sell your product for more than you paid for it? And did you sell enough of the product to cover your overhead? Finally, one more important thing, it tells you what your time's worth, right? Because at the end of the month, you've got a certain amount of profit left over, and that's why you got out of bed every day during the month to go work on your business and earn a profit. So how much is your month worth of time worth? That's the profit at the bottom of the income statement. Very telling. Very good. So let's learn some quick jargon about the income statement. Of course, the top line is always called sales or income or gross income. There's lots of different names for it, but it all means the same thing. The second section is cost of goods sold. That's how much that you invested in your product or service before you sold it to your customer. Cost of goods sold. That section, usually materials and labor together, is also called variable expenses. Anything that varies, any expense that varies based on how much of your product you produce or sell is a variable expense and therefore a pretty good candidate for the section of your income statement called cost of goods sold. Really important to have that in there so you know if you're selling each product at a profit, right? And there you go. Gross profit margin is the next line. So it tells you each product is being sold at a profit, or overall your sales are resulting in a gross profit margin, which of course then is the money left over to cover your overhead or fixed expenses. Different from variable expenses, right? Fixed expenses are what happens every month, whether you sell anything or not. That's your rent, utilities, insurance, that kind of overhead that happens month in, month out. What's next? Net income, that's the bottom line. In this case, you can see on the example on the right-hand side, you've got sales of 150, cost of goods sold of 20, expenses of 75, and therefore net income or profit of negative $55,000. Look real closely at that number. It's got a negative sign. It's got parentheses. Sometimes you'll see just a negative sign. Sometimes you'll see just parentheses. I put them both in there to be very clear. All right. And a bonus is depreciation. We're not going to talk too much about that today, but see my word of the day definition of depreciation because you should know that it is an overhead expense in most income statements, but often will be below the operating profit line. So you might not want to consider depreciation when you look at your income statement. That's a decision that you and your accountant have to make. All right, very good. Here, let's look at an example income statement. So on the left, just the sales and cost of goods sold section. Remember, that's just the top half. If this whole income statement were on here, it would flow off the bottom of the screen. So top half, sales and cost of goods sold. And look at this company. They're a manufacturing company. They make really big industrial machines. And the first thing they did is put the number of machines sold at the very top. That's really cool, right? When you're looking at the income statement, you see January and February, and you say, why are they different? Why are they so different? Why is there a $387,000 profit one month and a $300,000 profit the next? Well, look at the sales of how many units they sold. That's a key and really helpful for someone who's reading the income statement. It's not necessarily part of an income statement right out of QuickBooks, but something that you can add as a key to reading it. All right, sales, look how they've broken those down. Manufactured products, resale products, technical services. And then they did the same thing down in cost of goods sold. Manufactured products, resale products, technical services. So you can see each segment of their business generating both income and expense with regard to that sale. That's really cool. All right, after you deduct your your cost of goods sold from your sales, you have what's called gross margin, right? That can be expressed as a percentage as well as a dollar. And then on the right side, I'm going to take that back up to the top and I'm going to show you the bottom half of the income statement. That's the overhead or fixed expenses. So the operating expenses, fixed expenses, overhead, same thing, all the same meaning. Those include things like salaries and wages of the administration, of the CEO, of the people who are not involved in actually building the machines that they sell. Travel and entertainment, you understand that. Rent, telephone, maintenance and repairs, office supplies, all those are overhead expenses. And there you see depreciation. They did include depreciation in this particular overhead expense calculation. And at the bottom, then, we get our total operating expenses, and we can figure out our operating profit and loss. Look at that. They made $106,000 in January, and they calculated that out as a percentage of sales. Whenever you see a percentage sign on an income statement, it's a percentage of sales. So 106,000 is 9.8% of 1,089,000. That's the January sales on the left side. And then they had some interesting other expenses and other income. Maybe they sold a fleet truck, or they got a refund from their landlord, or they had, in this case, interest expense. You can put those things below operating profit because they're not really normal operational income and expenses, right? So you put them down there below, and then for tax purposes, let's say you can figure your final bottom line net income, in this case $104,000 for January, $73,000 for February. Pretty cool, right? So let's read an example financial statement. Another example on the right side here, a widget company, the famous widget company. When you see a financial statement like this, an income statement, you will say, during the month of February, in this case, you can see that at the very top of the financial statement, during the month of February, from the 1st to the 29th, 2024, we sold $150,000 worth of widgets. Okay, if you've got your sales broken down by category or division or whatever, you can talk about each of those sales categories. And that cost me $40,000 to produce, right? So I sold $150,000 worth of widgets, which cost me $40,000 to produce. That's $10,000 materials, $30,000 labor, $40,000 all in. And that left me with $110,000 of gross margin. Those sales left me with $110,000 to pay my overhead expenses of $75,000. That's your total overhead expenses. So I had net profit of $35,000 left over. It's really just that easy. As a bonus, you spent 160 hours in the business, divide that into your profit of $35 an hour, and you'll find out what your time is worth. All right, very good. So next is the balance sheet, the cash flow statement. Look for my other videos on that topic, and I will see you next time.
Thanks for listening. Visit fusecfo.com for our social media channels and more.